Inflation. Every investor today seems to be obsessed with inflation. Why? Well, it's quite simple really. If the price of goods and services begins to rise too quickly, i.e. inflation grows too fast, then central banks around the world will have little choice but to also raise interest rates. Now, aside from your mortgage or rent payments rising, this would also damage the stock market and potentially wreak particular havoc on the kinds of technology investments that have performed so well over the past 18 months. So, it's not an exaggeration to say, understand what's happening with inflation and you'll be most of the way there to knowing what is going to happen with the stock market. That's why in this video we're going to hear Cathie Wood's most up-to-date thoughts on inflation. In particular, we're going to be looking at how some markets are telling us inflation is coming while others are indicating the opposite. And then at the end, we'll conclude with which is most likely. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. For now, let's get straight into our first clip.
So what are the markets telling us about inflation? The markets are, they're actually conflicting. They're sending conflicting messages. Let's start with the stock market. The stock market itself is up. So it's not worried per se, but if you look at the sectors performing, you've got energy and financials at the top for the year, 54% and 35% respectively. Those two sectors are associated with strong economies, very strong boom time economies with a yield curve steepening, meaning long rates are rising faster than short rates are. So that would be consistent with inflation. But the other two top performing sectors are real estate and consumer discretionary. And those two do not benefit from inflation. They benefit from inflation coming down and lower interest rates. So that's very interesting. The stock market is confused about this topic. And what about the bond market? The bond market is clearly in the lower inflation, if not deflation camp. Now, there's some confusion even there because the tips suggest we're going to have negative real growth for as far as the eye can see. Obviously, we don't think that. I don't know why the bond market is saying that, and it's been saying that for a while. But in terms of the actual interest rate level, I think we're below 1.5 today. It has not continued to go up in support of this inflation narrative, not at all. So the bond market is squarely in the lower inflation, if not deflation camp. The dollar's going up. That is an anti-inflationary force. Crypto is in the inflation camp. If you think about Bitcoin as being a hedge against inflation, if that's how you're thinking about it, or NFTs being a hedge, collectible, a hedge against inflation. That could be in the inflation camp, as could housing. But let's talk about both of those. These are real assets, yes, and they can be hedges against inflation. But the stock market and the bond market are also assets. And we've got all markets rallying. All markets are rallying. And could this mean, therefore, that velocity is going down, the velocity of money? What does that mean? Now, this is a little esoteric, so forgive me, but I think it's really important. If consumers are spending their money on assets instead of goods and services, then what's happening is all of the money printing that people think is going to cause permanent inflation in the price of goods and services, that is wrong, that it's actually moving into assets. So velocity involves GDP and money growth. GDP is the production of goods and services, not assets. So the velocity of money has been coming down because people have been saving and putting more money into assets. Is that what's going on here? Well, in the GDP report this week, I think it was, or maybe it was last week, real GDP growth was 2%, a huge disappointment. But what the headlines did not capture is if you looked into the guts of the GDP report, what you would have found was the only reason GDP grew was inventories. And everybody thinks we're terribly short of inventories. Real final sales, so this is taking out inflation, real final sales were slightly negative. Now, could it be, and I'm seeing this behavior on the part of millennials, could it be that they would prefer not to spend on goods and services, but to invest, especially in crypto and NFTs and stocks? So very interesting there. But in terms of housing as an inflation indicator, Ivy Zelman of Zelman Research came out this week. She made a fantastic call on the housing bubble and bust starting in 05, 06. And she was right, just a little early. She is very concerned that the housing prices we're seeing now are not sustainable. And for a few reasons. There is a lot of speculation. And two of the reasons include iBuying and private equity. So iBuying, so that's when online brokers, real estate brokers, are willing to buy a home from someone who wants to sell, renovate it and flip it quickly, and take friction out of the home selling and buying process. Well, one of the major iBuyers out there this week basically pulled out of that market and said, this is unstable. This is an unstable situation. We're losing money. We're not going to bet the company on it. And I thought, wow, okay, that suggests something's changing in the housing market. We're also seeing massive inflows on the part of private equity and we have since 08, 09. They've made huge amounts of money from real estate, and they're continuing to pump more, buying up large tracts of homes all over the country, and then selling them off at a profit after renovating. That is unsustainable. And we're also seeing a lot of pre-market buying. This home, a real estate agent says, this home is not on the market, but I think I can get the owner to sell it at this price. We're seeing a lot of that here in St. Petersburg, Florida, and I think that's happening around the country. So not sustainable, so I'm wondering if even the housing market inflation is going to give way here.
Okay, so Kathy highlights some interesting points here. In particular, she's trying to gauge whether inflation is coming by looking at the following markets: the stock market, the bond market, real estate, cryptocurrency, and the dollar. Now, when it comes to the stock market, she believes there is no clear consensus. While energy and financials are performing well, this would indicate inflation is likely. Real estate and consumer discretionary are also high achievers this year. These, however, would point towards lower inflation. And also, the stock market is up, which would also indicate potentially lower inflation. So overall, the stock market appears really quite confused when it comes to inflation. The bond market, though, does not seem to be sitting on the fence. With the recent move in bonds, the market is indicating that inflation is not such a concern. And the same is seen with the dollar too. Inflation means the dollar weakening over time, but over the past 12 months it's actually risen when compared with other currencies. Now, of course, the point could be made, and validly, that those other currencies are also falling in real world value. But considering that most analysts believe the dollar would fall this year compared with those currencies, a strong dollar has certainly been a surprise and does counteract inflation. On the other hand, though, cryptocurrency has also been rising, and many view crypto as a hedge against inflation. So from this, crypto is indicating that inflation could actually be coming. For me though, I worked in crypto full-time for 4 years, and the most common theme that I always saw was people looking for a reason why crypto rises or why it falls. Now, while some news does impact the prices in the short term, the overarching force in the market is simply one of long-term adoption. Over the past 10 years, crypto has gone from zero adoption to relatively mainstream. Over the next 10 years, it will proliferate throughout society. This is what drives prices higher. The macro outlook may have an impact too, but crypto is so uncorrelated to traditional markets because its price rise is more related to adoption and network effects than anything else. And finally, we have real estate. Generally speaking, low inflation means low interest rates. Low interest rates or cheap mortgages are obviously good for real estate prices. However, Kathy believes real estate has been rising in a manner which is simply unsustainable due to the financial inflows into the market. As a result, it could be approaching a breaking point, and so it's not a clear indicator either way. So overall, there are indicators in both directions, and at the same time, most markets are at or near all-time highs. Stocks look relatively overpriced. Personally, I wouldn't go near bonds right now, except as a hedge. Real estate looks like a bubble, according to the analyst who called the last real estate bubble. And crypto, while it has so much long-term potential, and I obviously am a believer as someone who worked in the industry for years, it's also around all-time highs. We are in a situation today some are calling the everything bubble. Ideally, you would not want to invest too much in any one market. But at the same time though, cash looks like an even worse idea than everything else. That's why, for me, nobody really knows what will happen next. Not even the markets, as we've just heard. And so the only option is to diversify, to spread your money out between numerous different asset classes and geographies. That way, whatever happens, you can be exposed to the world's markets, but not too heavily invested in one area, bearing in mind any individual area could struggle in the coming months and years. But those are just my thoughts. Now I'm interested to know what you think. Do you think inflation is coming? Which market are you most heavily invested in? Stocks, real estate, crypto? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.